But for the time being, let's keep it with, of course, what is the road ahead for the Indian market. We have Satyam Panday, Chief US and Canada Economist at S&P Global Ratings, joining in. Thanks very much, Satyam. Thank you for joining us this morning. So first things first, this whole shutdown business, I mean, as of now, last two trading sessions, the market has completely shrugged it off. It continues to march higher. So is this going to be pretty much business as usual? There have been times where the government has shut down for more than 10, 15 days as well. Do you expect this to be a prolonged round, or is it a matter of a couple of sessions?
Well, it's a little bit hard to say this time. In the past, they've always come around after a couple of weeks with some kind of a negotiated budget deal. But it looks like this time around, they still need to see some polling. It really comes down to which party feels the heat from their respective, electorate, right? So right now, I think it's a little bit too early to say, but once those polling starts to come, some complaints start to come and the paychecks don't reach homes, that's when you feel the heat, and then both parties are going to try to come out with some form of continuing resolution, which is you're just going to kick the can down the road, maybe have a 6-week reprieve, and then again have the same debate come December.
Last time it was airport stuff, right? And airport delays and those kind of things. So it's got to hurt the consumer, and then there's a backlash. So something will give in at this point. At some point, markets completely ignoring all this, right? So this is, it's high drama but low impact in that sense.
Yeah, in the past, they've always come around with some kind of resolution, and it doesn't really impact your GDP growth as much. If you think about it, 1 week of this kind of partial government shutdown is going to shed about $6 billion. And then that's only at the time when it's shut down. And folks do get repaid. There's a back pay for folks that are not being paid right now. So at the end of the day, it's a little chump change in the big US economy when things open up again. So that's why markets are. Plus, the markets are also thinking the Fed's going to provide some more rate cuts. Some of these data that's not coming out, but given the private sector data that is showing weakness, I think the market is going with, we are going to get our monetary policy easing anyway. So they are right now not quite worried. One thing to note, this time around, we don't have any debt ceiling sort of a discussion going on, right? We are kind of safe on that front. So maybe perhaps markets are kind of taking it easy for that reason as well.
All right. Hi, Satyam. Always good to see you. When a couple of points out there, then Fed rate action, that's going to be important. What's going to the response be? And that case gets stronger for rate cuts. How many are you factoring in for the remainder of this year in 2026? And the other part is, we have briefly spoken from the start of this year about the probability of a recession in the United States. I think it was mid-teens. It had moved up to around 30%. What are you at now in terms of a probable recession in the United States?
Yeah, so let me start with the probability of recession. We had moved it up to 35% during the heat of the tariff, fiasco there back in April, right, the Liberation Day. But I think that some of that has faded given some of the negotiated rates that we have seen. Businesses have started to get used to this kind of new environment. And some of the numbers coming in, just honestly, the CapEx numbers on high tech, that has been really strong, surprising on the upside. So it does mean that the risk of a recession to begin in the next 12 months has gone down. So maybe perhaps even lower than 30% now. But that doesn't mean that there aren't any weaknesses in the economy. Clearly, there are some yellow flags. You can think of the labor market, consumer spending, the confidence and sentiments. All of those are still below what would normally be considered healthy. Having said that, I think the Fed is looking at the labor market very closely. Even though there is still excess inflationary pressures in the system, they are clearly weighing it on the employment mandate side. They don't want unemployment rate to further move up. And I think they are going to give that 25 basis point rate cut in their October meeting and perhaps again in December. It's a very gradual rate cut. We're not talking about sharp, fast rate cut like the recessionary rate cut. It's more of a tweaking around the edges, trying to get back to that neutral 3.1, 3.3%.
Satyam, could inflation at all play spoil sport in that rate cut trajectory? So far, it's been along projected lines, right? We're almost at what, 2.9% in the last print, PCE. So what's your prognosis next couple of months?
I think we are going to stay a little bit north of 3% in the core inflation numbers. And this is going to be there till middle of next year. And that is what is going to keep the Fed from cutting faster. If you really think about it, they could be cutting much more faster given some of the labor market numbers, but they are not going to do that because inflation numbers have been quite sticky. That's something to look out for, obviously. And that also affects the purchasing power of consumers and softer GDP growth in turn. So all of this dynamic is quite interesting right now, at least for the next 6 months.
Okay. All right. Thank you very much for being with us today and giving us your view on how the U.S. economy is shaping up. So barring the labor market, not too much else to worry about, at least at this point in time, and not even this government shutdown. Got that. Thanks, and you have a good weekend.